The views, comments, and opinions of the following program do not necessarily reflect those of Morris Media Studios, MorrisMediaLive.com, or its affiliates. Listener discretion is advised.
Good afternoon. How is everybody? And why am I looking up? I don't know, but let me look into this camera so you can see me. How is everybody doing? It's your girl, Shirley Nichols with Mortgage Money with Shirley, episode 8, coming to you live and direct here today, live in the Morris Media Studios in Los Angeles. We are on episode 8, Purchasing Power. And if you'd like to tune in live right now, we are streaming live on YouTube under Morris Media Studios on YouTube, and my personal page, hi, Shirley Nichols, on Facebook, and my business page on Facebook, Clear Sky Mortgage and Realty. So find us on those streaming live platforms, YouTube, Morris Media Studios, and my Facebook pages, both personal and business, Clear Sky Mortgage and Realty. And you'll find us right now live in the studios on today, Tuesday, July the 8th. And July the 8th. Isn't today the 6th? July 6th. Episode 8, July 6th here in the studios. Okay, so if you also like to call in and ask any questions, comments, or concerns, feel free to dial 323 area code 815-4204. Again, that's 323-815-4204. So let's get started. I hope everyone had a great, fantastic 4th of July. It seemed like this week holiday weekend was kind of long, right? It just seemed like it was long, but that just gave you time to digest and get prepared to buy your first house or your second or third home and start spending money wisely. That's what we're going to talk about today, the purchasing power that you have. You do. You might not know it, or you may not know what purchasing power is, but I'm here to tell you. So sit back, tag a few of your friends, bring them on the show, and let's go. It's a 30-minute show, guys. And then, like I said, if you want to call in, feel free, call in. Ask any questions, comments, or concerns, or after the show, I will always check the questions, comments, or concerns, okay? All right, so on with your girl, Shirley, and Mortgage Money with Shirley. So purchasing power. What is purchasing power, right? Purchasing power is when you have your credit together, you've got your employment history together, and you've got some cash money or reserves. All that comprises into purchasing power, right? So when you say to someone, I'd like to buy a house, specifically if you say to your mortgage broker, I'd like to buy a house, I'm going to say, okay, let's get started, right? Let's get started with an application to find out what your purchasing power is. And you're going to say, my purchasing power, and I'm going to go, yes, of course, your purchasing power. Are you trying to buy a $500,000 house? Or are you trying to buy $1 million house? What does your purchasing power allow you to do? What are you eligible for? What are you qualified to purchase is your purchasing power, right? Whether it's a $500,000 house or $1 million house. So what are you looking for? With lending, mortgage lending, what are they looking for? They're looking for the 3 basic things: your assets, your income, and your employment. That's it. Assets, income, and employment. So when we're taking your application, it's really simple. We're going to ask you those specific questions. So just have in mind, here's what I make year to date, or here's what I make annually, here's what my W-2 says, or on my tax returns, on my Schedule C, here's what the income shows. You're going to want to know what your income is, either monthly, annually, or based off of these tax returns, right? You're going to want to know what the credit looks like. You know, you don't have to know exact, because I'm going to pull your credit report. Yes, I'm going to pull a tri-merge. A tri-merge credit report is just basically all 3 bureaus that are pulled at one time. That's your Equifax, that's your Experian, and that's your TransUnion. All 3 of those reports are going to be pulled into a tri-merge. And we're going to look at all those scores, right? I keep saying all those scores, but the 3 scores, which are your FICO scores, your Fair Isaac, forgot what the C, corporation, O something, but your FICO scores. That's the fair, like I said, fair is the F, I is Isaac, C is corporation, and O is something else. But the FICO score is what we're going to look at to determine your interest rate and whether or not you're qualified to buy this house, right? So those 3 bureaus, you'll have 3 FICO scores. And between these 3 FICO scores, we're going to pick out that middle FICO score, right? You're not going to get the high score. You're not going to get the low score. You're going to get that middle score. So if you have an 800 as your high score and your middle score is a 700 and your low score is a 600, we're going to go right to the 700 and say, okay, that's what you're at. You're at a 700 FICO score. And then we're going to go on from there, right? So when you're taking this application, because you contacted your broker, Shirley, and you said, I want to see what my purchasing power is. I'm going to say, okay, let's pull your credit. And then you tell me, where have you been employed for the last 2 years? Have you been self-employed? Are you working with, ABC Corporation? Where are you employed and how much money are you making? Now, let's go back a second because I want to kind of tackle each of these categories, right? So let's go back. We talked a little bit about the credit, but I want to kind of go back a little bit more and touch back onto that credit because I talk about this on previous episodes, but I really want to drive this home for those of you who are thinking, well, I co-signed for my boyfriend, or I co-signed for my girlfriend, or I co-signed for my spouse, or I co-signed for my child. I want to bring back this whole topic of credit because there's certain questions that I get. I promise you, I've been doing this for like 28 years and I still get these questions about credit. So let's kind of tackle this credit segment just for 1 second here. When you co-sign, okay, let's be real distinct and clear about this co-signing business. When you co-sign, that means you, Mr. Co-signer, you are just as responsible as the person who is the primary signer. Yes, you are. You are just as responsible. What that means is this. You co-sign for Bobby Ray. And these are all just fictitious characters, guys. But I'm really trying to bring home this part because I think some of you all are kind of stepping around or tiptoeing around what this co-sign business means. So you co-sign for Bobby Ray in his new Chevy, right? Bobby Ray and you break up, or Sally Sue. You co-sign for Sally Sue or you co-sign for Bobby Ray. Some kind of way there's a breakup in the relationship. And Bobby Ray says, well, you know what? Forget you. Me and my car are going to go down the street. And Sally Sue says, forget you. And me and my car are going to go down the street. But the credit is still on the street. Okay. The credit is still on your credit report under your name. And if they decide that they, meaning Bobby Ray or Sally Sue, if they decide not to make a payment, it's going to ding your credit. That's it. It's going to ding your credit report. So you got to be real careful about co-signing for someone. Co-signing is different from being an authorized user. Okay? 2 separate things. You've got one is a co-signer, and that's exactly what it is. You signed onto this loan as a responsible party to this contract. Okay? That's a co-signer, where you've given them your social security number, name, address, date of birth. You co-sign so that that person would be eligible for that credit, right? You are a co-signer, a responsible party. Now, an authorized user or an authorized signer is different because, yes, it goes on your credit report. However, when you and Bobby Ray or Sally Sue break up, they can take their car and go on because you're not responsible, so to speak. All you have to do is call into that lender and say, hey, I no longer want to be an authorized user or signer. Now, it doesn't really work with car loans and that kind of thing because you're typically helping that person get qualified for that vehicle or even for a house. Okay, we'll talk about that here in a minute. But remember, a co-signer for a vehicle or a house, any of that stuff is exactly what it is. It's a co-signer. You help them get qualified. Now, if you're an authorized user, and typically authorized users are for credit cards, right? Credit cards that person already has established. So Bobby Ray may have had a $10,000 limit with Citibank. And he already qualified for that credit card years ago without you. And he decided that, oh, this $10,000 balance may look good on your credit report. So, hey, do you want to be an authorized user so that can boost up your credit scores? Now, let's talk about that. Okay. And I hope that this is all making sense and kind of registering with someone, because again, these are topics and examples and questions that I continually get. And I want to make sure I'm setting the record straight with a lot of people out there, because I think they kind of get sidetracked about what it is as a co-signer and an authorized user. Now, I understand there are some clients who want to build up their credit scores rapidly, or they want to build up their credit rapidly. And so they'll go to Bobby Ray and say, hey, I know you had this $10,000 credit limit with Citibank. Will you put me on your card as an authorized user? And Bobby Ray and you are in a loving relationship. He says, oh, sure, I'll put you on that card. Now, here's the thing about credit and how credit works, right? So he puts you on this Citibank card as an authorized user. And when we pull your credit report, we'll see Citibank will show up and it'll have a little A underneath. That tells the lender you're just an authorized user. That's all. So here's what happens when you apply for a mortgage loan. Now, I'm only speaking about the mortgage industry because I don't work for the car people or Citibank. I work in the mortgage industry. When we pull that credit report and we see that A, but here's the kicker. We see an A, that means authorized user. We see Citibank with a limit of $10,000, but we also see a balance of $10,000. And we also see a payment of $500 a month. So what you've done essentially is you've kind of hustled backwards. You know what I mean? You kind of hustle backwards. You were trying to hustle forward by adding this credit card on your credit report because the limit is $10,000 and me and Bobby Ray love each other. He said he's going to help out my credit. He has a $10,000 credit limit. But what Bobby Ray forgot to tell you is his credit card is maxed out, or that balance matches the limit, right? So now you have a maxed out credit card on your credit report. And instead of your scores going up, they either stayed the same or they ticked down just a little. Does that make sense? Right? So you're not really responsible for this credit card. You're only an authorized user, but you don't want something like that on your credit report trying to build up your scores, because that's not going to help you. Okay? It's not going to, quote unquote, ding the credit. If he doesn't make a payment, you want to hurry up and call that Citibank and say, hey, get my name off of there so it doesn't ruin your credit report. So it's a little different from being a co-signer, but it's still the same. It's still the same tactics, so to speak. You wanted it on your credit report. It's on your credit report, but it just doesn't help you if the limit is here and the balance is here. It's maxed out. It doesn't help you. So that's the credit card. If Bobby Ray doesn't make a payment, you want to quickly get that off of your report. And all you have to do is call up the lender. Hey, guess what? I'm Shirley. I don't want to be on Bobby Ray's credit report or credit card anymore. Please remove me. It's just that simple. However, when you co-sign, it's not as simple. It's not, let me call BMW and say, hey, I don't want to be on Bobby Ray's loan anymore. It's not that simple. So be mindful when you're co-signing and when you're an authorized user. Okay? Two separate things. Now, a little bit more about credit. I'm going to go into assets as well. Okay? We're still talking about this purchasing power because, again, if you have this credit card, this Citibank credit card on your credit report and it's not really helping you, your purchasing power hasn't increased. It hasn't increased. So, again, be mindful of what you're trying to do to get this purchasing power going. So let's jump into credit/assets, okay? Now, or reserves for that matter. And a couple of podcast episodes back previously, I talked about assets and reserves. And those are two separate things as well. So I talked about that previously and I'll kind of touch on it now. But I want to really get into another thing that people often ask me. Hey, Shirley, can I go and apply for a signature loan? Right? At Bank of America or Wells Fargo. Can I go apply for these signature loans? My answer is sure. You can always apply for whatever you want to. But here's the thing. If you're trying to get this purchasing power built up, applying for a signature loan to get reserves or assets in your bank account may not be the move. Now, what do I mean by that, Shirley? Well, this is what I'm talking about. So you call me and say, hey, I'm getting ready to go buy this $1 million house, but I need an extra $10,000 of reserves in my bank account so that I can close this mortgage loan, right? And so the first thing I'm going to say is, if you go open up or apply for a signature loan, first of all, your lender is going to know about it. FYI, guys, once we take your application and start the process of your loan, whether you're buying a home or whether you're refinancing your property, once we start that application, we are alerted, okay? We are alerted from the underwriter typically that, hey, Bobby Ray just went and applied for a signature loan at B of A or Wells Fargo. We get those alerts. There's no hiding. Once we start your application process and actually submit your loan, okay, this is after the submission. So you applied for the loan. I told you what you were qualified for. You're like, okay, let's go with it. You send me all of the documents I requested. Then I send your file to the underwriter. When the underwriter gets it, you are now in submission process. You are now processing your application to be approved to get closed. Once this process starts and you tiptoe outside your house to B of A to go get whatever you're trying to go get, once they pull your credit report over at B of A, we know about it instantly. There's no hiding. There's no getting around it. And what you don't want to do is start applying several different places, okay, right? What you don't want to do is start building up what we call, or what is known as, credit inquiries. Credit inquiries are not your friend. What'd you say, Shirley? Credit inquiries are not your friend. So in other words, once you start this process, don't start applying here, and here, trying to collect monies for assets or reserves, okay? That is a no-no. You do not want to go out and start applying here, and here to get assets and reserves. Now, what you could do, right, is before you came to your broker, Shirley, what you could do 60, 90 days in advance, go get the money then, put it in your bank account and let it sit, or let it, what we call, season, right? So we'll typically tell you to have your assets seasoned, and seasoning is 60 days. That's all, 60 days. Put the money in that account for 60 days and then you call me, okay? So now, going back to the original question, you call me, hey, Shirley, can I go apply at B of A or Wells Fargo for this signature loan? Sure, go right ahead. Are you going to affect your purchasing power, Bobby Ray? Well, yes, you are. So let's talk about what it is that you're trying to do. If you're trying to go to B of A or Wells Fargo, and I keep throwing these guys out because they're just the first names that come to my head. But if you go to your bank, whomever it is, credit union, wherever, and you apply for a signature loan, and your end game, your end result is to have a stack of cash from your bank saying that, okay, here's a signature loan and I've given you $10,000. Now, they may approve you, right, for the $10,000, but they're also going to attach and assign a payment. They want their money back. So they give you $10,000 and then they say, but we're going to need $500 every month from you. So what you've done is, once again, you've alerted the underwriter, right? You've alerted the underwriter that you applied for something, and then they're going to ask you for all the documentation, and the documentation is going to get to the underwriter, and it's going to say, oh, and by the way, Bobby Ray has a new monthly payment with a new line of credit for $500 a month. So now all of a sudden, that $1 million house that you thought you qualified for, it dwindles down to about $750. Because they have to take in consideration this monthly payment that you just applied for trying to get reserves or assets. Yes. So that's why I throw caution out there to each and every one of you. If you know I'm going to apply and going to need assets or reserves, so I'm going to apply for a signature line of credit from my bank, do it 60 to 90 days in advance. Okay? We're still going to ask you about that inquiry that's on your credit report. We're still going to say, hey, why'd you apply? We're still going to do that. But at least you have your funds in the bank that are now seasoned. Okay? So does that make sense? When you're talking about assets and reserves and credit, you very well may need the assets. I don't know. You very well may need the reserves. But be cautious and careful if you're going to banks applying for these signature loans after your loan is in process, trying to get the money in your hand. If you're going to do all that, I just might suggest, not saying that you should do it, but I might suggest that you do it before that loan file gets to me or your broker. Okay, does that make sense? Okay, so that's that part about assets and reserves, because there's no getting around when you're purchasing a property. Refinance, different subject, different topic matter. But when you're purchasing a property, even with VA, when you've got 100% financing, even with VA, there are still closing costs and things that still need to get paid for. And you'll have a small balance to bring to the closing table, even with VA. Okay, so just know you're going to need some money before you close if you're buying a property. And like I said, not so much on the refinance side, but when you're purchasing a property, you're going to need some money somehow. So get some gifts, get your 401k together, get your retirement plan together, start asking the questions of, hey, how do I apply? What do I need to do? And now let me go back just a tad bit too. We talked about borrowing money from the bank after your loan was in process, right? And I said, you probably don't want to do that, right? You probably want to do it in advance. However, if you have a 401k or retirement plan, this is for 401ks or retirement plans, right? If you have a 401k or retirement plan, that you can borrow from during the process, okay? Because that is your money, right? And we typically won't count that payment if there's a payment against you, which, if you apply with your 401k or the retirement plan, you typically will call them and say, hey, do I have some sort of a financial hardship program that I can dig into? And I know that sounds crazy, right? I talked about this also a couple episodes back. I know it sounds crazy to call your 401k or your retirement plan and say, hey, I'm trying to buy a house, or is it a financial hardship that I can apply for? Believe it or not, financial hardship, I know that sounds crazy, but most 401ks, when you're trying to buy a house, that's typically what they call that program, a financial hardship. I don't know why, but during this time of processing your loan, after you've submitted your loan, you most certainly can go ahead and borrow and ask about the 401k. That payment, like I said, we typically won't count that payment against what we call your debt to income ratio. And this is all with that purchasing power, right? Because that's what it really boils down to with the purchasing power. Purchasing power, again, we're looking at your income, assets, and credit. All of that comprises your purchasing power, but we heavily weigh in on this debt to income ratio. And that's why I keep talking about, going on a card with co-signing with a card with Bobby Ray or Sally Sue. That's why I'm talking about that, because those payments, when you co-sign, that payment you are responsible for. That will go against your debt to income ratio. Authorized user, not so much, because like I said, you can always call that lender and say, hey, I'm buying a house. Take me off this credit card or whatever you have to do. Or there's some lenders that don't even count those authorized user payments against you when you can show proof that the other person that is really the primary user, not the authorized user, but the primary user, you can show proof that they've been making the payment out of their bank account and you had nothing to do with that. Some lenders will just take that documentation and run with it, and that's it. But that's the authorized user portion of this, not the cosigner, okay? Because all of this is what I'm talking about under the umbrella of debt to income ratio, or what we call DTI, right? Your DTI is very important. So we talked about credit, we talked about assets and reserves. Again, watch how you're receiving your assets and reserves. It's very important. Watch it if you're going to go to the bank and borrow money. Watch the timing of it all, okay? So that's income, assets, credit. Oh, no, let's go back to income, right? So we were talking about employment. Again, all of this is comprising this purchasing power. So every now and again, I'll get this question that says, hey, Shirley, I've been working with the police department for 10 years. But I think I'm going to start doing my own barbershop business. I'm going to go ahead and quit the police force, and I'm going to go over here and start my own barbershop business. And I'm going to say, congratulations, entrepreneur. Go ahead, go forth, be great. But maybe you want to buy the house before you quit the police force, right? Because here's the thing. With employment, and if you want to switch jobs, right? If you want to transfer or change jobs, you can do that. You're allowed. Sky's the limit. You can go forth and do that. However, in the mortgage business, be mindful and careful of where you're going to for the next job. If you are in the middle of buying your property and you're on the police force, right? So let's just say your close of escrow day is August 1. And here it is, July 6th, right? and you've already applied, you've been in escrow, you've been in the submission process for 2 weeks, and here it is, July 6th, and you've got a close of escrow date, August 1. And you call and say, hey, Shirley, I'm going to quit this police force. And I'm going to say, no, wait, just wait. Well, and then a lot of the times clients will say, well, they already verified my income. They already verified that I work at the police force. Yeah, we did. When you step through the door and we start the initial process, we verify employment at that time, yes. But we also verify that same employment, the police force, that same employment 5 to 10 days before we close. And if 5 to 10 days before we close, they say, oh, yeah, well, Bobby Ray no longer works at the police force. He's over here at Bobby Ray's Haircut Him. And I'm going to say, no. So the deal is off. Yes, essentially the deal is off because you've gone from the police officer to the barber. 2 different industries. And then the police force was a W-2 wage earner, salary, to Bobby Ray cut them all. And now this is tax returns, right? Cash money most of the time, That's what that side is. So you can't go from what we call a wage earner to a self-employed person in one setting of when you're trying to buy a house or even refinancing for that matter, right? So be, again, very cautious and mindful about employment. However you started that transaction, purchasing that house or refinancing, however you started it, try to make sure you end with it. Now, every now and again, there are some cases where it's not the same type of situation where you started with ABC school, high school, as a math teacher, right? ABC high school as a math teacher, they just shut down completely. They said, oh, we're not opening this school. We're not going to keep this school open. We're not going to do any of that. Instead, ABC high school has been shut down and you were their number one math teacher. You went across the street to Martin Luther King High School and they hired you as a principal. So forget being the math teacher, your number one math teacher at ABC school. Now you're over at Martin Luther King as a principal. That is fantastic. That kind of situation happens from time to time in the mortgage business. It happens. That's allowed. That is okay. Because you've stayed in the same education line of work. You didn't go from police officer to the barbershop, right? You stayed as a salaried employee with a W-2. You went from one school to the next school and you just got promoted from teacher to principal. That is fantastic. Have at it. Or there's some cases where you were working as a production manager over at O'Reilly's, and now you stopped working as a production manager and you went to Macy's and you're the manager. Same kind of retail operation, right? O'Reilly automotive, retail, Macy clothing, retail. As long as you're staying in the same field of business or line of work in the same industry, you're okay. And I say that, again, caution. Every broker, every lender, they're different. I'm different from the next broker. But I'm going to tell you, if you were working with Shirley, if you were to switch from O'Reilly's to Macy's, we're not going to have a problem. Okay? You were at this production manager and you went to the store manager over here. Or you may have not even been the production manager at O'Reilly's. Maybe you were the cashier, but you went over to Macy's and now you're a production or you're a manager. Whatever. It's still, all retail. So what I'm saying is this, be mindful and cautious about that employment because it all still goes in the pot about purchasing power. And another thing about this income business, this employment business, and I've had it this way as well. I've had it where a person was working at, let's say, the Dodger Stadium. And they had annual bonuses, right? And these annual bonuses were happening every single year of their 10-year career at the Dodger Stadium. Now they went over to the Forum, right? And the Forum, now they're working these concerts in these venues, but their annual bonuses are not annual. They're quarterly. We're still going to take in consideration these bonuses. When we don't take in consideration of bonuses, and if that's what you're using to increase that salary, the moment that we don't use those bonuses is because it hasn't been going on consistently for 2 years. That's the problem. Some people will say, I've been at the Dodger Stadium for 10 years and we've gotten these annual bonuses for 10 years and my income is $200,000 with the Dodger Stadium. But now I'm over at the Forum and my salary, my base is $100,000, and they don't really give out any bonuses. So what we're going to use is that $100,000 salary, not the $200,000 where you were getting bonus after bonus for the last 10 years. Or I've seen it the opposite. I've seen it where you were at the Dodger Stadium making $100,000 a year, no bonuses, and then you went over to the Forum and now you're making what you say is $200,000 because you're going to get all these bonuses, right? But the bonuses just started to happen this year, this month, because you switched jobs. You switched from working at Dodger Stadium now to the Forum. Well, guess what? The Forum says you're going to start getting these bonuses, but it hasn't been consistent. It hasn't been happening for the last 2 years. We're not going to count the bonus. We're not. I know that sounds crazy, but bonuses are not guaranteed for the most part. Most employers are not guaranteeing bonus because bonuses are typically based off of either your performance or the company's overall bottom line and performance, right? So if that company doesn't really know if they're going to be able to afford the bonuses this year, and there's no track record of Bobby Ray getting these bonuses, that's what the lender's going to say. Well, hey, we don't know. There's no track record. There's no history of Bobby Ray getting these bonuses. And we don't know if the Forum is really going to give out bonuses this year because, by golly, we just came off the pandemic. And we don't really know if the Forum is going to perform their annual pipeline or their budget or whatever it is that they're using to pay you that bonus. We just don't know. So guess what? They're not going to count it. So again, your purchasing power, be mindful of your employment, be mindful of your income, and be very mindful about that credit, that asset in the reserves. So I hope you all got a little tidbit about today. I know I get animated and excited about Bobby Ray and Sally Sue, but listen, these are real life stories and experiences, guys. And I just want to bring it to you so that you can make a wiser decision and have an easier, smoother ride to the finish line when you're ready to purchase your house or refinance this property. I just want it to go smooth and easy for you guys. But if you have any questions or comments or concerns, we're at the end of the show once again. Where did this time go? I promise I just sat down in this seat. I promise I did, or at least that's what it feels like. But at any rate, if you all have any questions, comments, or concerns, please feel free to leave the comments on my Facebook page. Again, my personal page is Shirley Nichols, or my business page is Clear Sky Mortgage and Realty. And you're right here, Mortgage Money with Shirley on Tuesday, July 6th. If you have any questions or comments, again, please feel free to leave the comments, or you can contact me on my cell phone, area code 818-720-7575, 818-720-7575. I'm on every first and third Tuesday, maybe Wednesday of the month, every first and third Tuesday or Wednesday of the month. And I hope, like I said, I hope I brought some valuable information that you can use. Mortgage Money with Shirley. And always, if you need to, press the replay button and replay. So thank you so much. Hope to see you all at the end of the month. Bye.